Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday the 13th of May, 2025, and joining Lee to pose some questions on the financial market themes for the week ahead is Seiko Kataoka-Fisher, Head of Japanese Client FX Sales. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi, Lee.
Hi, Seiko.
It's been another volatile week in the FX market. What has caught your attention over the past week?
Yeah, a couple of things. Obviously, the dollar weakening trend was in place for most of the past week, with the dollar falling to fresh year-to-date lows yesterday on the back of further evidence of the US economy softening in response to the protectionist trade policies of President Trump, and the policy uncertainty remaining so high is obviously having a negative impact on the US economy. We saw in the latest initial and continuing claims data that does point towards further softening of the labour market, which, if that continues, will open the door for the Fed to cut rates again later this year. And at the same time, this week, we also saw clearer evidence as well that inflation in the US is continuing to slow at the start of this year. So if you look at sort of core measures of inflation, those have been kind of roughly flatlining over the last 2 to 3 months, which is certainly better than maybe the Fed would have anticipated at the start of this year. And certainly, if it wasn't for the fact that President Trump has put in place these higher tariffs and created all of this uncertainty, Fed potentially would be in a position next week to start cutting rates. We don't think that will be the case. And obviously now with the uncertainty, the Fed still wants to see what happens before they're willing to cut rates. But yeah, certainly it does create more room further down the line for the Fed to cut rates. And I think that's contributing to the weakness in the dollar that we're continuing to see this week. Having said that, though, obviously today we have seen the dollar bouncing back alongside other safe haven currencies like the Swiss franc and yen. That's obviously in response to the military strikes from Israel on Iran overnight. That has triggered, at least initially, a kind of flight to quality bid in the market, boosting those traditional safe haven currencies. On the other hand, investors have obviously decided to take some kind of risk off the table going into the weekend, given we don't know if the situation will escalate further in the coming days. It certainly sounds like that could be the case based on the rhetoric from officials in Israel and Iran. So for the FX market, that has triggered a liquidation of some of the kind of carry trade positions that have been built up recently. Particularly some of the emerging market high yielding currencies have been hit harder, such as the South African rand, Mexican peso, and the Hungarian forint.
There's a busy schedule of central bank updates in a week ahead, including the Fed, Bank of Japan, BOE, and SNB. What are you expecting?
Yeah, like you said, it's a busy schedule of central bank meetings upcoming next week. In light of obviously the military developments and geopolitical risk increasing in the Middle East, that just adds to the uncertainty for central banks over the outlook. So from a simple point from that alone, it would suggest more caution from central banks, which would kind of fit with our view and the market's view that most of those central banks are going to leave policy unchanged next week, including the Fed. Like we said before, we think the Fed is comfortable to keep rates on hold for now, and that we think really the earliest point that they'll potentially cut rates is September. You can't completely rule out July, but I think for that to happen, you need to see a particularly bad payrolls report at the start of next month. The main kind of central bank to start the week in terms of kicking off proceedings will be the Bank of Japan. As we know, they've already expressed more caution recently about hiking rates further because of the trade policy uncertainty. So really the focus next week is going to be more about what they do in terms of their tapering plan. I think the expectation has been building in the market that they will slow down the pace of tapering from the upcoming fiscal year from April 2026 going forward. That to us looks like a highly plausible scenario. Obviously, if they were to slow that pace of tapering down, that could be seen as dovish shift, at least initially by the market, which could already be encouraging yen weakness, despite the pickup that we've seen in safe haven demand for the yen at the end of this week. The other central banks, obviously the Bank of England, I think for the Bank of England, we're expecting them to kind of acknowledge the recent soft labour market data that we've seen from the UK, pointing towards further weakness there in the labour market, which we think should give the Bank of England more confidence that they can continue with the current quarterly pace of rate cuts. So we're more confident again now that they'll cut rates again in August. As we've seen this week, that weaker labour market data and also the bigger than expected kind of payback weakness in GDP data in April after the very strong growth we saw in Q1. That has certainly contributed to the pound underperforming this week, helping to lift euro sterling to fresh highs. And then finally, the other kind of central bank that we think could be more of a market movement next week would be the Swiss National Bank. I think the expectation is that they will lower their policy rate back to the zero bound, given inflation continues to significantly undershoot their target, falling into negative territory again in the latest months. So pressure will certainly be on the Swiss National Bank to keep easing policy going forward. And while they can't completely rule out that they could deliver a bigger rate cut and bring rates into negative territory, we think at this stage it's probably a bit too early to anticipate that they would go down the negative rate route at this point in time. So for us, the market's probably going to be watching more closely to see whether the Fed, whether the SNB leader indicates that they're open to negative rates in maybe one of the following meetings in the second half of this year. If we were to get that kind of indication, that could trigger some weakness in the Swiss franc next week, obviously depending on whether the tensions in the Middle East escalate. Obviously, if they were to escalate significantly, that would put further upward pressure on the franc.
Thank you very much, Lee.
Thank you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe, and contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.